Before we dive in, hit subscribe so you don't miss new episodes. If you find value, a quick copying, helps us reach more people. Let's get started. Okay, let's picture this. You've built a really substantial portfolio of stocks, fantastic for those long-term growth goals, but then, bam, a brilliant investment opportunity lands in your lap, or maybe an unexpected financial need pops up. How do you actually get to that value locked in your shares without having to sell, face a pile of taxes, or throw your whole investment strategy out of whack?
That's the central puzzle we're tackling today, isn't it? It leads us to a fascinating area of finance. Stock loans. We've been looking at an article titled Unlocking Liquidity, Navigating Stock Loans in Australia, APAC, and Europe from May 20th, 2025. Our goal today is to really, unpack this for you and explore how you might tap into what the article calls lazy capital.
Lazy capital.
Yeah, those significant listed securities you're holding.
Exactly. We want to give you a clearer picture of this, sophisticated financial tool that could offer some serious financial flexibility. So let's dig into this challenge first. Having wealth that isn't easily accessible. You've got a great stock portfolio, a truly valuable asset. But what happens when you suddenly need a significant amount of cash? Maybe there's a new business venture or a strategic acquisition for your company. What are the typical routes?
Well, the most obvious first thought might be selling some stock. But as the article points out, that can quickly get complicated. Selling triggers capital gains tax, which, can take a significant chunk.
Yeah, definitely.
It might also send signals to the market, possibly affecting the stock price. And of course, it disrupts your long-term plan. That strategic disadvantage becomes particularly sharp where CGT is high or you need cash quickly for something time-sensitive, right?
Right. And what about trying to borrow against those shares the old-fashioned way, through a bank?
Yeah, traditional lending against shares, that can also be quite complex and often restrictive. Banks, especially with tighter regulations now, can be pretty hesitant, risk-averse when it comes to this type of lending. So you can find yourself in this situation where you have a valuable asset, but it's not readily usable when you need it most.
Which is frustrating.
Exactly. And this is where stock loans come into the picture as a potential strategic solution.
Okay, so let's define it. In its simplest form, what exactly is a stock loan?
At its core, a stock loan, as the article describes it, is a non-recourse or sometimes limited recourse loan secured by your publicly traded securities. So you, as the borrower, pledge a certain number of your shares as collateral.
Okay.
In return, a specialized lender provides you with a cash loan. Now, here's a really key point that differentiates this. You typically retain what's called beneficial ownership.
Beneficial ownership. What does that actually mean in practice?
It generally means you continue to receive the economic benefits, like dividends, and any potential increase in the stock's value. Though, the specifics can depend on the exact loan agreement, of course.
Okay, and you mentioned non-recourse. That term keeps coming up. It sounds like a pretty significant advantage. How does that work?
It really is. It's a major differentiator, offering a significant layer of financial security. In a true non-recourse stock loan, if the value of the shares you've pledged as collateral drops below the loan amount, well, the lender's recovery is usually limited just to those pledged shares.
Just the shares.
Just the shares. Your other assets, your house, other investments are generally protected.
That's a huge difference from a margin loan then.
Absolutely crucial difference. With a margin loan, a drop in stock value can trigger a margin call, forcing you to add more funds or sell shares, maybe at a loss, and potentially impacting your other assets too.
That peace of mind factor seems, massive. What else sets these stock loans apart from more traditional ways of leveraging your holdings?
There are several key characteristics that make them pretty unique. Firstly, there's the process of collateral transfer. While you keep that beneficial ownership, the economic benefits, the shares themselves, are usually temporarily transferred.
Transferred where?
To a custodian, or often into what's called a special purpose vehicle, an SPV, which is controlled by the lender. Think of an SPV as like a separate little company set up just for this loan. It holds the shares, adding security, and sometimes helping with that off-balance sheet aspect we might touch on.
Ah, okay.
This transfer gives the lender the security they need for the loan's duration. Then, once the loan is fully repaid, plus interest, those shares come back to you.
So it's like a secure, temporary holding pattern for the shares.
That's a good way to put it. Another important aspect is that these loans are often highly tailored. Unlike more, standardized bank loans, stock loans from specialist providers are frequently customized.
Customized how?
To fit your individual needs, the specific shares you're pledging, things like the loan amount, the loan-to-value ratio, or LTV.
Right, how much you borrow against the value.
Exactly. That LTV, the interest rate, the repayment schedule, all that can often be negotiated.
Interesting. And the article mentioned this idea of off-balance sheet potential. What's the real benefit there? Is that common?
Well, it depends very much on the specific jurisdiction and the accounting rules. But yes, some structures might be considered off-balance sheet financing, the potential benefit. Enhanced financial privacy, maybe improving certain financial ratios because the loan liability doesn't show up directly on your balance sheet.
But not guaranteed.
Definitely not guaranteed. It's very specific to the situation, the jurisdiction, the accounting. You absolutely need expert advice on that.
Understood. So just to clarify, the main goal here is accessing cash for other things, right?
Yeah.
It's not really about leveraging up to buy more stock.
Precisely. The article emphasizes that distinction. Margin loans are often for leveraged speculation, these stock loans. They're primarily for liquidity, funding businesses, diversifying into other assets, handling personal financial needs, all without selling your existing holdings.
Right. Unlocking existing value.
Exactly. Unlocking that value, not necessarily just amplifying stock market exposure. And it's also different from, say, traditional securities lending.
How so?
In traditional securities lending, institutions lend out shares, often for short selling, and the lender of the shares gets a fee. With a stock loan, you, the shareholder, are the one borrowing the capital against your shares.
Got it. Okay, so for someone who has a lot of their wealth tied up in stocks, what are the specific advantages that make these loans appealing?
There are several really compelling benefits. The article highlights confidentiality and discretion first. These are typically private agreements, so you avoid the public disclosure that comes with selling big blocks of shares.
Which could move the market or alert competitors.
Exactly. They also often offer speed and flexibility. The application process can frequently be faster than traditional bank finance, especially for liquid, well-known stocks. And as we said, the terms themselves are generally more flexible, more tailored.
And you still get the upside if your stock performs well during the loan period.
Absolutely. You retain that economic exposure, so if the market value goes up, you benefit from that appreciation, obviously net of the loan costs. And you usually keep receiving dividends. In some structures, those dividends can even help offset the interest payments on the loan.
That's quite neat. And we have to circle back to the non-recourse point again, that security aspect.
Yes, that limited liability provides significant peace of mind. It's a huge draw. But maybe one of the biggest advantages, particularly relevant for listeners in Australia, is the potential tax efficiency.
Ah, yes, the capital gains tax, the CGT.
Precisely. In Australia, a properly structured stock loan is generally not considered a disposal event for CGT purposes.
Which means?
It means you can access liquidity, get cash out, without triggering an immediate tax bill on your capital gains. You defer that liability.
Wow. For founders or long-term holders sitting on highly appreciated stock, that must be a massive consideration.
It's often a primary driver, absolutely. It allows strategic moves, diversification, funding other ventures, all without that immediate, sometimes very large tax hit.
That Australian CGT angle really does sound significant. Now, what about Europe? Are the drivers the same, or are there different nuances there?
In Europe, you see similar core benefits, but the emphasis might shift slightly depending on the country. Places like Switzerland, the UK, Luxembourg. The tax implications will vary, of course, that's crucial, but the article points out uses like liquidity during complex estate planning.
Okay.
Or, say, a family office wanting to seed a private equity investment without selling their core blue-chip holdings or dealing with lengthy bank processes.
So speed and discretion again.
Exactly. And raising capital discreetly for strategic opportunities. Europe's sophisticated financial infrastructure, often involving offshore custodians and SPVs, facilitates these kinds of private, efficient transactions.
To really make this concrete, the article gives some great real-world scenarios. Let's start with that Australian tech founder example. What was their situation?
Right. So this founder had a very large chunk of their wealth in shares of their recently listed tech company. Highly concentrated position.
Common scenario.
Very. They wanted to diversify into commercial real estate, but were reluctant to sell a big block of shares, partly market perception, partly that big CGT bill we mentioned.
Makes sense.
So the solution was a stock loan. They pledged a portion of their shares, got a loan for about 60% of their value, the LTV, used that cash to buy the property, diversified, and crucially, deferred the CGT. And apparently, the dividends from their tech stock even helped cover some of the loan interest.
That's a really smart, tax-efficient way to diversify.
Yeah.
What about the Swiss family office example? private equity focus there.
Yes. This family office saw a great chance to co-invest in a private equity fund. Needed $10 million fairly quickly. But they didn't want to sell any of their core portfolio of European blue chips held for long-term growth.
So another liquidity need without disturbing the core strategy.
Precisely. They used a stock loan, pledging a diversified basket of those blue chips held with a private custodian. Got the $10 million, made the PE investment, kept their core holdings intact, and avoided the typical bank borrowing hassle. Plus, the non-recourse feature protected their wider assets.
And the final one, the London entrepreneur needing bridge finance.
Yeah, this UK entrepreneur was waiting for proceeds from selling a private business, but needed £5 million now for another time-sensitive investment.
A timing gap.
Exactly. Their main liquid asset was a large holding in a FTSE 100 company. They arranged a short-term stock loan, shares held offshore, with flexible repayment terms. They got the £5 million bridge funding quickly and discreetly, made the investment, and then repaid the loan when the business sale cash came through. No need for a forced sale of their public shares.
These examples really do show the versatility, don't they? Strategic uses across different situations. So why this rising popularity now? What's driving it?
Yeah, the article points to a few key interconnected factors. One is definitely credit tightening by traditional banks. Banks are just more cautious, more regulated, especially with securities-based lending. So people are looking for alternatives.
Okay, so banks pulling back pushes people elsewhere.
Partly, yes. And then there's that concept we started with, unlocking lazy capital.
Yeah.
There's just so much value tied up in stock portfolios that isn't actively working beyond appreciation. Stock loans put that capital to work for other goals.
Right, activating dormant value.
Exactly. Then there's the growing need for capital agility. Markets move fast, opportunities pop up, needs arise. Stock loans offer that speed and flexibility.
Makes sense. Any other drivers?
Technology and transparency improvements are helping too. Better data, more efficient pricing from specialist lenders builds confidence. Also, the evolution of offshore structuring refined legal frameworks using SPVs for better asset protection and confidentiality, that appeals to many.
And just more awareness generally.
Definitely. Wealth managers, advisors, they're increasingly aware of these tools and recommending them where appropriate. So education is spreading.
Okay, so for our listener who's thinking, maybe this could work for me.
Yeah.
What are the absolute critical things they need to consider, the due diligence points?
Right. This is crucial. Due diligence is absolutely paramount. The article flags several key areas. First, the asset itself. Not all stocks are suitable collateral. Lenders strongly prefer liquid shares, high market cap, low volatility, traded on major exchanges, ASX, LSE, NYSE, etc.
What about ETFs?
Some ETFs, maybe some listed managed funds might be considered, but it depends on the lender and the specific product.
And the loan to value, the LTV.
Yes, the LTV ratio. That determines how much you can borrow against the shares. It typically ranges, say, 40% to 70%. What you get depends on the stock's quality, its volatility, market conditions, the loan structure. A lower LTV means more buffer for the lender, less risk.
And we cannot stress this enough, the jurisdictional treatment, especially tax. Like that Australian CG2 point.
Absolutely critical.
Yeah.
You must ensure the structure works in your specific tax jurisdiction to avoid nasty surprises. In Australia, it's CGT. In Europe, you might worry about withholding taxes on dividends, cross-border issues.
So specialist advice is essential.
Non-negotiable. Specialist tax and legal advice tailored to your specific situation. And just to reiterate, what we're discussing here is general information, not advice for your circumstances.
Absolutely. What about where the shares are actually held during the loan, the custody and legal structure?
Very important. You need clarity on where the shares will be held. Reputable lenders use established regulated custodians, and the legal agreements, often involving those SPVs we mentioned, need thorough review by your legal counsel. Understand the collateral security arrangements completely.
Okay. And the loan term and costs.
Terms are often in the 2 to 5 year range, typically. Shorter terms might cost more. Interest rates vary based on LTV, stock risk, loan size, duration, market rates. You could have interest-only periods or amortizing payments. And critically, understand all potential fees set up, legal, custodial, everything. Get that clear up front.
And choosing the lender themselves, that sounds vital.
Hugely important. Only work with trusted, experienced, well-capitalized lenders or specialist brokers with a proven track record in this specific type of financing.
Do your homework on them.
Absolutely. Ask for references, check their background thoroughly, and finally, be aware of the potential risks.
Even with non-recourse.
Well, even with true non-recourse, the primary risk is managed. But if it's limited recourse or at loan renewal, A huge drop in collateral value could lead to requests for more shares or partial loan calls. Rare, but possible. There's also counterparty risk, the lender's stability. Though good structuring mitigates this, you might also lose voting rights on the shares temporarily, depending on the structure. Clarify that up front.
In complexity.
Yes, these aren't simple loans. The documentation, the structure, it requires professional guidance to navigate properly.
The article also made a point of contrasting these with something like NAB Equity Builder in Australia.
Yes, a very important distinction. Products like Equity Builder are typically recourse loans, meaning the lender can come after your other assets if things go wrong. They often have higher variable interest rates and are designed specifically for borrowing to invest more in the market. The stock loans we're focused on today are generally strictly non-recourse or limited recourse, often have lower fixed rates, provide liquidity for various purposes against existing holdings, and are usually arranged privately. Different tools for different jobs.
Right. So bringing it all together then, what's the key takeaway message about stock loans for our listener?
I think the core message is that stock loans can be a really valuable, flexible tool for accessing liquidity, especially if you don't want to sell long-term holdings or trigger immediate taxes. In today's financial world, having that kind of flexibility is powerful for high net worth individuals, family offices, corporate leaders, particularly in places like Australia and Europe with significant listed equity. Well, understanding these loans can be a real game changer.
So it's more than just a loan, it's a strategic financial tool.
Exactly. It enables funding new ventures, managing obligations, diversifying investments, all potentially more efficiently. It's about turning that lazy capital into active capital to help you reach your goals.
Thanks for listening. If today helped or made you think, hit Kawa, like it tells the platform this content matters. And tap subscribe if you haven't already. See you next time. And for that final provocative thought, consider the significant capital you currently have tied up in your long-term investments. Could exploring sophisticated tools like stock loans unlock new possibilities for your financial strategy and help you achieve your objectives in ways you might not have previously considered?